Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP, accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work-optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Well, good morning, everyone, and welcome to the Millionaire Next Door podcast. And today we have a repeat guest with us, Sam Miller. He's the Director of Research at Signature Estate and Investment Advisors, SEIA, which is my firm. And we are going to talk about a really interesting topic called direct indexing. This is probably new to most folks. It's somewhat cutting edge, but it's really an evolution, and it's something we're embracing, and we wanted to get people familiar with the concept. So, Sam, tell us about direct indexing, what it is, why we're embracing it as a strategy for clients, how you see it being used, et cetera.
Absolutely. And great to be back with you here today, Rob. And if I was to summarize direct indexing, I would say it's at the intersection of technology and investing, which is enabling investors to build stronger portfolios ultimately. So there's been an evolution in our industry. And I would say this sort of a concept isn't necessarily new. It's been around for a while, but it's definitely changed over the course of time. And there's been a renewed interest because it's resonating with a lot of people. So if you go all the way back to 2020, there were some consolidation in the industry. BlackRock, which is the big name out there, they acquired a shop called Aperio. Morgan Stanley acquired Eaton Vance, which owns a group called Parametric. JP Morgan bought a group called 55 IP. There were all these different headlines that we in the wealth management community noticed, a lot of developments, and it seemed like an arms race. Everyone was, seeking to get the strongest technology to be able to build these sorts of portfolios. So we saw that, and we've certainly been paying attention, and we've been using these strategies even before then. But it's interesting to note the big names in the asset management community are investing more and more in this space. There's actually a quote from a group called O'Shaughnessy Asset Management recently, and they think that by 2025, most financial advisors will use web-based software to create and manage these sorts of portfolios for their clients. So that's not that far away. I don't know if that's going to be the case. I think it's possible. There's a long way to go to get there. But ultimately, what is it? It's direct indexing is a methodology that allows an investor to essentially personalize and customize their portfolio to a greater extent than ever. And there's a lot of different use cases out there. Step one in the process is figuring out what your North Star is from an investment perspective. You want to figure out if you want to track the S&P 500 or the Russell 3000, or maybe a global index or a global benchmark like the MSCI ACWI. That's step one. And in many instances, we can build out portfolios with mutual funds and ETFs. That's certainly an acceptable way to go about building portfolios. But what these direct indexing providers do is actually break those vehicles up and own the underlying stocks instead of using a fund. So instead of maybe owning the S&P 500 ETF, you would own close to 500 unique stocks in your account, or maybe a subset of that if you can get the same amount of diversification with 200 or 300. And the question is, why do you do that? The reason is, in many of these instances, by breaking it up into the component parts and the component stocks, you can get some tax benefits. So as the market goes up and down, as financials go down in recent days and technology stocks go up and down, the manager and the technology can take advantage of those fluctuations in the market by tax loss harvesting very aggressively and creating essentially an economic asset for you when you go out and and do your taxes. So that's one of the reasons that we break it up into the individual stocks instead of owning mutual funds and ETFs. That also allows investors what we call, customization at scales. You can apply ESG preferences, which is something we talked about on a previous podcast. Let's say you're morally opposed to certain companies and you say, I never want to own XYZ company in my portfolio because I don't really believe that what they're doing is a positive for the environment or for society. It's really easy to exclude that sort of a company by name or by style from the portfolio. You can also apply factor preferences if you wanted to overweight a certain style, like value stocks or dividend stocks, if you're trying to drive a higher degree of income in the portfolio. So it allows you to really customize the portfolio to a greater extent than most investors have been able to historically. And then the costs have really come down a lot over the course of time, where if it costed, 0.5% to 1% 10 years ago, those numbers have been cut in half in recent years here. So it's much more affordable to access. So those are some of the kind of the why behind it. To get into some of the use cases to a greater extent, we got the proactive tax loss harvesting that I mentioned. Many people will start thinking about tax loss harvesting in December, right before year end, and they miss out on a lot of opportunities intra-year as the markets go up and go down. So by applying this technology, you can access more proactive tax loss harvesting. So if you're an investor who really cares about minimizing your taxes, that could be really important. Another piece is what we call a tax budget. You can apply a tax budget to the portfolio. Let's say you rode the bull market for the last 10, 15 years or so, and you've got some built up gains in your portfolio, and maybe that's causing some significant overweights or underweights in certain areas. That can be risky in terms of your portfolio's health, but it also can be a challenge to get out of those positions without triggering an excessive amount of taxes in the process. So what you can do is set what's called a tax budget and say, for example, I don't want to realize any more than $10,000 worth of taxes in a given year, or $20,000, whatever the number is. You would work with your advisor to understand what that number is and what's important to you. And then over the course of time, you would start to wind down those positions more gradually. And it's not a rip the Band-Aid off approach. It's much more thoughtful, much more gradual, and easier on the investor to do it that way. Another use case would be if you've got maybe a single or a small group of positions that have appreciated in value to a significant extent. Maybe you have held Apple stock for decades, and all of a sudden it's become 20, 30% of your portfolio. Again, that can present some outsized risks from a diversification perspective. What this portfolio can do is build around some of those bigger positions and do what's called a completion portfolio and really help to diversify in the process. So that's another use case. I mentioned custom ESG previously, so really custom tailoring the portfolio to what's important to the investor from a ESG or maybe a faith-based perspective. We just did one for a client who cared a lot about Catholic values, so we were able to construct a portfolio that aligned directly with what the Catholic Church is saying at this point. So sometimes it can be a faith-based use case. Another one would be, what we call active engagement with the companies. So proxy voting best practices. A lot of times you don't really have a lot of insight into how your proxies are being voted. By working with some of these, the managers that we work with, you can have more of a say in those proxy votes and aligning what's being voted on with your personal values. And then another one, we can do security and sector restrictions. Let's say, for example, maybe someone works for a Big Four accounting firm and they're on a project and they can't invest in a certain company or a certain sector. By using the technology, you can exclude that entire sector from your opportunity set. let's say you have a client who or a person who works for a big oil company, and they have so much of their personal wealth and their prospects for wealth tied to a single stock or a single industry. It sometimes doesn't make sense to double up or triple up on that within your portfolios. By using a direct indexing approach, you can potentially exclude that from your portfolio. So it just allows you a lot more flexibility at the end of the day. But I think I ran through probably 6 or 7 different use cases. It is a bit of a Swiss Army knife. It doesn't, there are certainly pros and cons with it, but it does tackle a lot of pain points for our clients. And that's why we're continuing to see a lot of interest in it.
Yeah, that's great. You covered so much there, and you did bring up a lot of use cases that are really applicable. I mean, to me, this sounds like an example of sort of just cutting edge technology filtering down, and that's a big part of our practice, is kind of marrying high tech with high touch. And a huge value driver again is tax efficiency. So, one of the things I know is, for example, and maybe you can comment on this, we these big swings in the market when volatility picks up, they're able to go in and do like intraday tax loss harvesting. Is that correct?
Exactly. So every manager, I mentioned a couple at the outset, they all do it a little bit differently, but big picture wise, yes, they're going in and they're proactively, capturing those losses, and maybe they're swapping out one tech stock for another so that you're still getting the exposure at the portfolio level that you'd like. You're not running afoul of the wash sale rules, which is an important factor, but you're also capturing that tax asset as well that you can use.
Yeah, so this is a really, really great evolution. And you brought up so many use cases. Of course, low basis appreciated stock. We see it a lot. Things like Apple, Honeywell, maybe someone's working for a regional bank in the area. These are all folks we work with. You brought up other things, Big Four accounting firm. I have a client there, and yeah, you're right. There's some restrictions. Introduction from Texas recently. I believe it was like Islamic values based, but no meat in there, no firearms, couldn't even have financials and things that generated interest. So the ability to customize that is amazing. Implementation wise, are there minimums for clients that would want to put this strategy in place, or how does that work from a pragmatic standpoint?
Again, it'll vary a little bit based on which solution is best, but the minimums typically start around 100,000 for a pretty commonly used index like the S&P 500 or something like that. If you wanted to get more granular, more esoteric, the minimums could go a little bit higher, but that's really what we're seeing on the ground here.
Okay. And bouncing around a little bit, I did see a table, which I don't know if I have it. Maybe we could get in the show notes if I can share it with Patrice. But it sort of compared mutual funds, ETFs, direct indexing on all these things that it can do. It's been an evolution from mutual funds to ETFs to direct indexing. And it just, you'd see on the direct indexing, it checks a lot more of the boxes, especially around tax advantaged investing, tax efficient investing. That's a huge driver of what we do in our practice and how we add value. And it's super important to a lot of folks. Very few of us say that's not important, even if they're not super high income earners, or we want you to be less tax efficient. Not sure if you have any comments around that comparison why between those strategies, but just putting it out there.
Yeah, we certainly see the value in different vehicle types, from mutual funds to ETFs to individual stocks, closed-end funds, you name it. There's certainly pros and cons. I think there's a time and a place for an active mutual fund in a portfolio, but for people that really care about tax management, I don't think anyone's going to argue that mutual funds are the most tax efficient vehicles out there. They're just simply not. ETFs are more tax efficient just by nature of how they're constructed and how they operate. But then, as I was mentioning a few moments ago, with direct indexing, you can actually supercharge that further by owning the underlying stocks to a greater degree and taking advantage of the fluctuations under the hood that you normally wouldn't see. If you own an S&P 500 ETF, maybe it goes up a couple percent or down a couple percent a day, but within those 500 stocks, there's a lot of movement. So direct indexing allows you to take further advantage of things from a tax perspective.
Right, right. And I heard about another really great scenario. We haven't applied it yet, but if someone has a future taxable liquidity event, maybe they sell a company or there's a big capital gain coming down the line, they can start to accumulate or bank some losses or to offset that future event. Is that one you've encountered or considered? I'm just curious.
Yeah, absolutely. You could certainly take advantage of loss carry forwards and use them at a future date. There's different market environments that are better or worse for tax loss harvesting. So if you think about, what do we experience over the long term? Thankfully, markets generally go up. Of course, there's no guarantee of that, but we believe that with improvements in productivity and the world generally gets better, the market's going to go up over the course of time. But that's not the case, as we know very well last year. And in different areas of the world, ask a Japanese investor how things went for the last several decades. Like they had a pretty flat market. So a choppy market is really good for tax loss harvesting and generating those sorts of losses that you can bank for the future and carry forwards. A declining market's really good for tax loss harvesting. But if you get a market that just takes off, there's, your tax loss harvesting opportunities tend to go away pretty quickly. So certainly there are different market environments where it works better or worse.
Yeah. Right. But there's so many pluses here with respect to, customization or the ability to add values, but also have it be tax efficient. We've dealt with these low cost basis, highly appreciated positions that are much too large a percentage of a normal portfolio, but there they are in that position, for years. And there was a pretty good tool set of things, but this feels like a next level type strategy to me in the toolkit. And have you been adopting it a lot? Or are we bringing this? Are you seeing it brought in and used quite a bit, or is it so new that how many are we at the early adoption stage, or is this up and running and people are using it on a regular basis?
I would say it varies a little bit, but I think we've got some good adoption since we've started using it more heavily a couple of years ago. I would say it is the fastest growing in terms of, in percentage terms. So I think we're starting to see more and more adoption relative to more traditional types of portfolio management.
Right. And just so folks understand, we can help walk you through this. If this applies, we're reaching out to clients where it's applicable. All those strategies that those big firms saw and probably spent good money to bring the technology, we can access most of those through our platform. So Sam researches those platforms, figures out what's optimal. We reach agreements. We have access to those as an independent, financial advisor and fiduciary. Is that a accurate way of presenting how this works here?
I truly believe that's one of our biggest value adds is monitoring the investment universe, understanding what's out there, and then bringing what we believe is the best of the best to our clients and our advisors.
That's great. And I love how this dovetails with our last conversation on, values-based, ESG, environmental, social governance. All those values, those can be brought in a tax efficient way. I really have yet to meet anyone who objects or their values are against saving on taxes. So not sure if you've encountered such an individual, but this is amazing. We just wanted to let folks know this is out there. We're thinking about it. It's, I think these do-it-yourselfers, might not be aware that this exists. I could almost guarantee they aren't aware. What else? Any other thoughts, scenarios, just sort of words of wisdom or things you want to impart about this strategy? But we could definitely help, and we can bring Sam on to client conversations on a call, on Zoom, etc. if we're ferreting this out. But Sam, I'll put it back to you to see if you have any other thoughts or wisdom to share on this front.
Yeah, I want to highlight the flexibility of the strategy. Again, I mentioned it as a Swiss Army knife of sorts. Of course, it's not the cure for all that ails, but it is a really good tool in the toolkit. So tax management's critical. It's one of the real areas where we can add value. But tax loss harvesting sometimes isn't the most important thing. Let's say someone loses their job and they find themselves in a lower tax bracket temporarily. Maybe that's a good time to actually realize some gains in a portfolio. The software and the technology can also do that. So that's just we talk about tax loss harvesting all the time because people want to minimize their taxes, but as an advisor, we can see the big picture. We can see where someone sits from a tax bracket perspective in any given year, and based on their goals and expectations and where they might sit in the future, we can have an open and honest conversation about what they might want to do today. So I think that's one of the benefits. And then also we're talking about taxes, but I've seen some of these sorts of strategies being implemented in IRA accounts from an ESG perspective or just from a customization perspective. And in those cases, we would turn off the tax loss harvesting. Doesn't make any sense in those cases, but just because we're talking about taxes doesn't necessarily mean you can't do this sort of thing in an IRA as well.
That's great. And I really love the analogy to the Swiss Army knife, that it's such a useful tool. It's got all these different, tools or modalities. Doesn't mean you always use it, but if you own that Swiss Army knife, you're going to get a lot of uses over the lifetime. And it's a pretty inexpensive way to have access to a lot of tools. And so I love that. Also kind of a shout out to our integrated professionals, CPAs, maybe tax attorneys, things like that, who may be listening, where we coordinate with. They should know this is out there. This is a tool and a strategy, and we should be integrated on that process with clients and their other tax, or legal advisors, et cetera. So it's a great discussion. I love it, and it just integrates so well. And you're bringing up, use in IRAs, right? So it might not be for tax, but from the customization and the exclusion of things, really powerful. So thanks again, Sam. This is great. We've had you on 3 podcasts. We started with a basic introduction of our whole research. We went deep into ESG. Now we're talking about direct indexing. I could definitely see us bringing on some other topics. So I'll let you have any last words if you like, but just really want to thank you for sharing your wisdom on this. And we're ready to work with anyone who might be interested or find this a benefit, and have some discussions about how it might benefit them.
Yeah, I certainly appreciate the opportunity, Rob.
If you'd like to reach out to me, I can be tracked down by all the normal means. You can simply email me, rcurtis, CURTISS at SEIA.com. I'm on Facebook. I'm on LinkedIn. You can do a web search and, find my office, give a call and get scheduled for some time. But I'm reachable if anyone has any further questions or wants to discuss.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors or Royal Alliance Associates Incorporated, member FINRA SIPC. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.